Hi, everyone. Welcome to Crowd Forecast News, episode number 174 for March 19th, 2018. We'll be discussing the 234th weekly report. And if you haven't had a chance to take a look at this yet, you should see it on your screen right now while I'm talking. Also, you can go to TimingResearch.com and you can download the full PDF there. You should be watching on the my new live page on Timing Research. If you want to switch over to the YouTube page, though, there is a link there that you should see. Anyway, my name is David Kosmeter. I'm the creator of TimingResearch.com, and I have Michael Filighera here, a longtime guest and moderating CFN for the first time. So I'm going to go ahead and turn it over to him.
Thanks, David. Again, my name is Michael Filighera. I am with logicalsignals.com, which is my own website. And today, to help us pick apart the markets and kind of give some good responses, we have Christian Fromhertz of Tribeca Trade Group, Lance Ippolito from Alpha Shark, and Jim Kenney of Options Professor. To start the show, why don't we just do a round table, and we'll again start with Christian and then Lance and Jim, and do an introduction of yourself and who you're with, and then we'll move on to the questions. So we'll start with Christian.
Okay, thanks for having me on. I always appreciate being on the panel. So love being back to hear everybody's ideas and discuss some of mine as well. And yeah, so I started. I was an institutional trader at Merrill Lynch for a number of years. I traded pretty much any type of equity product on an equity trading floor. My specialization was in ETFs and in Delta One products, and then I recently started Tribeca Trade Group about 2 years ago. And what we do at Tribeca Trade Group is I run an all-day option trading room. We basically read the tape. Obviously days like this are pretty interesting. And then I provide actionable trade ideas based on aggressive option flow, as well as what I'm seeing in ETFs. And I mesh that together with looking at optimal technical signals and setups. And I bring that institutional type trading desk over to my trading room. We really concentrate a lot on teamwork and collaboration. And then I run two completely transparent portfolios. One is a cash trading type portfolio, systematic portfolio, as well as an option portfolio. So again, thanks for having me on. Appreciate it.
Great. Thank you very much. Next up, Lance.
Hello, everyone. I'm Lance Ippolito. I started as a CTA, actually, a few years ago for a commodities fund here in Florida. And then I ventured off into the hedge fund world, mostly doing long only, very conservative long only strategies. Now I moderate for Alpha Shark during the day, and I also run a private trading service, Trading Coach Lance, where I have a private Twitter feed, a private Slack channel, and I've started to live Twitch a little bit for the video gamers out there in the morning. It's pretty a cool concept. A lot of people play video games on Twitch. They actually had Kim.com and Drake and a few other people get something like over 500,000 views. So I Twitch instead of video games. I've been doing trading mostly, and right now I focus more on short-term option trades, some day trades and equities. Really not too much futures anymore. Just I feel like the futures trading is just a little difficult nowadays. But I really focus on, I call it odd stocks or junk stocks. A lot of retail names, a lot of names with highly short interest, where I feel like I have the advantage in the options market and not the market makers. So I've kind of scaled down, trading the Facebook, Apple, Netflix, Amazons, and started looking at, different stocks like Macy's, DSW, Snapchat, VRX, stuff like that. Weight Watchers, one of my favorite names that I feel like I could trade well, that aren't, so subject to, if the NASDAQ's down 2%, Facebook's going to be down, Apple's going to be down, stuff like that.
And thank you very much. And then Jim.
Sure. I provide the content over at optionprofessor.com, which is an educational firm going over all the different uses and risks of the options, from cash flow strategies like credit spreads and covered rights to limited risk speculation with two-sided trades like strangles and straddles, and how to roll positions up and down as they move around. And then finally, hedging, which obviously is very important, particularly when we've had such a major league advance up towards 2,900 on the S&P and such parabolic moves. Things such as collars and married puts are certainly strategies that everyone should at least be aware of.
Great. Thank you very much. We're going to jump right into our questions from today, or for today. And we're going to try to answer the first two, so we're going to keep our answers brief, and we'll get into more detail in the responses. So the question one, which direction do you think the S&P 500 index will move from this coming Monday's open to Friday's close? So that's from March 19th to the 23rd. And then coupled with that, question number two is rate your confidence in the answer to, are we going to be higher or lower? And again, we will begin with Christian.
Okay, cool. So I guess the question is, from the beginning of the week, and we're down we're down 1.8% already in the S&P and sliding here. Slippery slope. Qs are down 2.7%. So obviously, if it was from the beginning, the morning of today, I would probably say lower to flat. Now that we're down this much, I'm going to go and flip on the other side, and I will say higher at this. Up. I'll use the level here in S&P futures 2706, and I'll say higher by the end of the week, and I'll say 70% confidence level. Again, obviously looking at where we are now and not where we were in the beginning of the day. And I'll go into reasons in the next segment.
Great. Thank you very much. And Lance.
I remember last time I added this question, I did 50-50, and it wasn't, the confidence level was not a valuable response. So I'm going to say from here, personally, I think we stay flat. Maybe we go down a little bit for the end of the week. So I'm going to say at a low confidence level, I'll use 55%. We see more downside for the rest of the week. Like Christian said, we're sliding here from the open. We're continuing to trade lower, hitting some negative 1,000 ticks here. So right now I'll go with the short-term trend and say lower.
And Jim.
Well, from the opening today at 2741 or so, I would say the confidence level is pretty high that it would be lower. From here, obviously, they took 50 points almost off the screen, so it's harder to have the same confidence. This thing right now, the VIX is exploding. And if you look at across the board, whether it be semiconductors, energies, or all the rest of them, they're all really on the run, and everyone's very frightened on what they're going to hear about this Fed situation. So if it's going to be sell the rumor, buy the fact, you'll bounce by the end of the week. If it's going to be, hey, listen, 3 or 4 rate hikes, it's not going to help valuations. It's not going to help, much of anything out there apparently. And so, I would say from here, it's 50-50, but, the way the momentum is and everything else, I would say it's more likely than not that we could be lower than here.
And thank you very much. And for me, I am also going to go with lower. And we'll get into our reasons in the next question. But I'm going to say lower, and I'm going to give it about a 65% confidence level on that one. And for those of you, you can read in the report that David has sent out on just the breakdown and also on some of the data. So make sure that you check out that report and get more information on why and where all of these answers are coming from. Question number 3 is, for your answer to question 1, share what specific reasons you think the S&P will be heading in the direction you have chose. Again, with Christian.
Yeah, sure. So yeah, just interesting as we're talking, the VIX just sliced through up to 2160 and hasn't really turned back from this open. But yeah, I mean, I think that a lot of this is just tape driven, headline driven. as well as we've got a big meeting on Wednesday, and it's the first one for a new head of the Fed, and I think there's definitely some nervous hands in there. I do think we are getting, so I think things can flip around after that Fed meeting. I don't think it's going to be as bad as everybody is predicting, but I think it's just we've had such a very calm, Yellen really gave us no volatility every time around. So, does this make sense? I think a little bit, with being that we had a Fed president that was just very predictable, kind of said the same thing every meeting. And now we're in a territory where things are a little bit more uncertain. So I do think we're seeing a knee-jerk reaction, but I think by the time we get through that on Wednesday, things will settle down. And I really don't have another reason for that other than, everybody, a lot of earnings reports that have been coming out have been pretty positive. Last week, we just saw another round of good earnings reports from some of the smaller tech, your second tier tech companies. They've been pretty hot. I think they did get a little bit over. They went a little bit too far. Got ahead of themselves. So it's natural for a pullback. You have Facebook headlines, but other than that, I don't think things really have changed, other than needing a little bit of a pullback and some nervous hands in the marketplace.
Okay, thank you very much. And Lance.
Yeah, so a few things to kind of look at the pros and the cons of the market. Pros, earnings have been spectacular. I will admit some of the good reports have been sold off, like AVGO. We had top and bottom and stock acting a little bit weak. And then Micron, we have reporting this week, which, with the big run up of Micron, who knows? I think something like this is, good report. Maybe the stock moves a couple bucks, but, again, a little bit overextended. To go to the downside, or for the bears out there, you can make the case we've had, money flow into a select group of stocks like an Amazon, Facebook, Micron, Nvidia. The FANG trade making so much part of the NASDAQ. If they start to unwind, we could see a great market crash. Personally, I think it's two things. Number one, what I've been looking at and what I feel like is very useful, even for intraday or short-term trading, is looking at high yield, or HYG, or you can look at junk bonds. We've never had, even though with this next leg up, especially in the Qs, HYG has been stuck, and it has been reacting pretty poorly, even though we've seen, the Qs, for example, or the Russell trend higher. And then second thing is European and global markets. We can look at EEM, or the DAX, or the Euros, FEZ. Just they haven't got much going. Even with, again, the leg up we've seen in some of the indexes. And I can even say the Dow, for that point of view, the Dow's been relatively weak. But really, if you look at it from a psychological level, the retail traders, if we think about the February decline, where we had, all the VIX product explosion, retail had it made in January. Every day, it seemed like, I think we had 4 red days in January. Retail put money in the market. I think the SPY is at 267.85, and they saw their 401ks, their trading accounts, their investment accounts, everything up money. February, they puked out a little bit of it, but here we are right back up. Here they are up money again. I think if we retest that in the SPY, 267.85, and retail, when they get those monthly statements in and they say, hey, my $100,000 is now worth, $95,000. Why is that happening? How am I losing money? I think that could get a little scary. And in the financial markets, there's no free lunch. If retail had one quick decline and then we went straight up again and they never had any other pain, I just think that would be too easy. So I think we retest a move lower in the SPY, kind of shake out the weak hands one more time, and then take it from there.
Right. Thank you. Very interesting. And Jim.
Okay, well, I've been having a theme, and I'm going to stick with it. And the theme is basically we had a very big parabolic move up towards almost 20. At that point, 400 points above almost the 200-day moving average. When that occurred, that was ridiculously excessive, if anybody ever follows the difference between price and 200-day average. And so what followed was a very big mini crash, where we had all the vol traders having to buy back their their positions. So what happens after a parabolic up and a big sharp down? My feeling is a trading range. So that's been my view. 2,800, 2,850 on the upside, 2,600, 2,650 on the downside. And now we're just going back down into the trading range further. While the market digests the parabolic move that it had, that obviously the circumstances are changing a bit, because if we have 3 or 4 rate hikes, that has to affect valuations and people who buy dividend stocks, because you can get the same kind of rate in the T-bill. So those are the factors going on right now. Now, where's the line in the sand on the downside here? Well, I think right now your 2680, 2650 is a neighborhood you'd certainly like to hold. And of course, the low that we saw on the move, 2530, 25, and the 200-day average at around 2580, that's the next neighborhood you'd like to hold. And then if you want to be bullish, which you still could be, because a lot of the averages are still pointing up, you're going to be bullish because you think next month, when they announce Q1 earnings, that they're going to be so offsetting the penalties we're seeing here now that people will jump on the bull train again. So if you want to be bullish because you think overall, this repat money, this buying back of stock that's supposed to reach about 51% higher than it was last year, about 800 billion in buybacks. If you want to get on that train and you think that train will continue to run, then this sell-off we're seeing would be a sell-off to buy into.
Okay, and thank you. We're going to share a couple of just off of the report, what respondents were basically saying on the higher respondent answers. Some of the choices, the reasons that they gave was good Republican policy. There's no bear sentiment in the majority of places and people. That they believe tariffs and the taxes, so the Tax Reform Act, are going to be very positive for the market. And earnings in Russia, they say, is going to propel the market higher. And then somebody wrote, they have a hunch that the market's going to go higher. Myself, I am a long-time Elliott Wave analyst, and what I see coming is actually, I think the market, or the S&P, will find support around 2650, as Jim mentioned just previously. But I think that the position that the market is in, that it could slide through that pretty quickly. And beyond that, next stop is 2550 and 2500. And I really believe that we're going to start to accelerate. So if I have to balance that against what the news that may be coming this week, I would say that they're not going to like what the Fed is going to say, or more importantly, because I think finally people are beginning to pay attention to what's going on in Washington, D.C. and what's happening within our own country. And so if we start to really see some outside pressure coming from Europe or Asia, I think that we really could begin to slide much harder and drop an additional 100 S&P points or more. And that could be, as was mentioned earlier as well, that washing out the weak hands, setting up the next rally, et cetera, et cetera. I believe that that does take place, but we don't know for certain if that's actually what people are going to do. But in the process, it does wash out the weak hands. So I believe that we're going to actually pick up some acceleration to the downside, and that's going to take us at least an additional 100, 150 S&P points lower. And whether that all happens this week, I don't know. But I wouldn't put it past it, since today it's already knocked off 50 pretty quickly. And going back to our report, the next question basically is, have you ever, or do you currently use any type of auto trading executions with your strategies? And how well has that worked for you? So we'll begin with Christian.
Sure, and I confess I was the person who answered hunch, by the way, on the last question.
Were you?
It's a good hunch.
I have a hunch. So So for automated strategies, what I have in one of my portfolio, I do not have anything that I have like stops set in stone where, you know, if we get a level all of a sudden electronically, I have an order and it gets stopped out, which I think is the question. But what I do have in my systematic cash trend portfolio, I do have levels that I honor for stop prices. So I have them built in. It does need a human, which is myself, to kind of get involved. But once I basically, every time I enter into a new trade in my cash trend portfolio, I've got the stop set. So I'm always looking at when, as soon as I initiate a trade, where is the trade not going to work out? And I have that all built into a spreadsheet, and I'll look at that several times during the day. Today is a good day to be looking at that, because if any of my stops do get hit, what I will do is go ahead and sell. This way, it's kind of an emotionless strategy, and I do like that type of strategy. Again, it's not anything automatic where I've got stop orders that are in my accounts, because I think that's very dangerous. Yeah. But I think absolutely, you know, having taking the emotion out of trading and having this predetermined every time you get into a trade. And if the trade does not work out, rather than, you know, kind of fight yourself and go back and forth and say, well, I thought I was going to be right in this trade. You know, a lot of times, you know, traders and beginner traders, they never want to admit that they're wrong. Admitting that you're wrong is fine. You just don't want to stay wrong. Right. So, you know, everybody's going to make mistakes. And that to me really kind of keeps me out of trouble, where I've got something built in, and, you know, I kind of trick myself, which you have to do it sometimes, and just say, hey, I have more confidence in my whole trading system than I have in any individual pick that I've done. Okay.
I just want to clarify, because maybe that'll add, or you'll be able to add more. I think what we're looking for here is auto trading execution. So I'm taking it as, do you have an algorithm that's running in the markets and is actually taking trades for you, and entry and exit?
No, I don't do anything like that. You know, I like to mesh a couple different factors, but no, I don't have anything that's just automated and just taking signals from certain areas.
Right. But we all realize that's a very heavy product, or it's a very heavy part of our markets today, that we have HFT, algorithmic trading, across the board in all markets, I believe, and particularly very heavy in the options market. And so you just have algorithms that they're just out there searching for trades. Right. And when they get them, A plus B equals execute. So Lance, you're up.
So right now, I have no involvement in auto trading, and in the future, to be honest with you, I want no involvement. I feel like, you know, yes, I can't look at a million things during the day, and I probably miss out on tons of stuff. But again, I feel like, you know, I've kind of eliminated, I feel like, a good amount of emotion in trading. I feel more confident than I do in myself than in a computer. The reason why I say that is, a couple years ago, I had me and a PhD, very smart man, he created automated trading system for the E-mini S&P futures. And you know, the program, everything, we ran it through, you know, I did nothing. All I would sit there and monitor it. It would make all the trades and everything like that. The spreadsheet, everything was built out. For a couple months, it worked out very well. This was, you know, again, couple years ago or so, we had a low volatility environment, and, you know, could it trade better than I could the S&P futures? For sure. You know, it had no emotion tied to it. The problem I ran into with it, and I've tested out a few back in the day, is they either A, have to be updated, you know, according to market conditions or just from the programmer, and then B, I feel like the ones I tested, they would work for a couple months or so, everything would seem great, but then something would go off, or just the overall market or volatility would pick up so-and-so, and just I felt like after a couple months, I had no longer confidence in them or in the automated trading platforms. And I just thought, you know, it became for me more of a headache to even monitor and to set up than anything else. You know, if I had hundreds of thousands of dollars to allocate to a system and had, you know, a team of programmers to run it and stuff like that, and we did that strictly, you know, possibly, but I don't come from that background, and one trading system or two trading systems, I just feel like it's not worth the risk versus reward of you know, having them possibly blow out or having a computer failure or something like that. I'm just not a fan of them. And, you know, in the future, I know we're getting more to automated stuff, but, you know, again, I'm like Christian. I like reading the option flow. I like trading options. You know, I could put a set stop in for my long stocks and stuff like that. I'd rather do the physical clicking and monitoring it than being dependent on a machine.
Great. Thank you very much. And Jim.
Yeah, I have no interest in that, and have never had any interest in that. And in this particular year that we're entering into, with the volatility definitely changing tunes, I don't know that I want to have a bunch of automated stuff going on with the kind of potential volatility that could be coming down the pike.
Thank you. Well, my response is yes, I do. I have had several algorithms written for me, but my style of trading, I was an options market maker, and here on the Pacific, but also on several markets within Europe. And so I kind of agree with what's already been stated, in that there's some difficulty for a lot of traders to kind of jump into having a computer determine what your entry or what your exit's going to be, and to try to play volatility in the markets. At the moment, though, my main focus has been trading futures. So I trade the Dow, I trade the NASDAQ, the S&P, gold, crude, and the euro primarily. And within those markets, I had some algorithms written for me, but what they do is it gives me enough input so I can program what I want for that particular day. And I think, as Lance had mentioned, it's like you can get into a position where you have a computer program that is making decisions for you, but it's it's true, but it's, for me, it's basically making a decision based on the input that I'm giving it. And what I have found to be that it's a very useful tool is that many times traders are not willing to take the trade, and because they're still trying to, you know, gather all this input in their mind and make a decision: do I go short or do I go long here? And what I have found is that with the auto trader, you get into the trade, and then you're in position to take advantage. Now, also with my particular auto trader, I can set it up to where in the futures market, I can put on multiple contracts. You take one off plus 10 ticks, you take one off plus 20 ticks, et cetera, et cetera. Or you can run it and it'll just take it from what I call signal to signal. And so your stop is really a volatility stop. What I've developed over my time is that I work with trending markets. So I also agree with what I believe Jim or Christian, you said, that there are times, excuse me, when the markets are really just going to be range bound. And to have an auto trader in that period of time is not going to really do you any favors unless you're programming it properly to when to get in and how long to sit with a trade. Auto traders work extremely well in a trending market. And that's primarily the functions that I'm using it for. And I am finding it to be very helpful and to be it's very successful in the trading. But again, it's determining in the morning which market do you want to use and what settings are you going to put into place. So I've also developed just strategies around what I'm calling market moods. Something's going to be range bound, you can program it so you're not going to get stuck, buying when everybody's selling and selling when everybody's buying and get caught in these crossfire. But I do think that it is how larger groups are trading now. So a lot of the trade in the market is that there are so many algorithms running at any given time across the entire spectrum of all of our different markets that I kind of just sat down one day and I said, well, if you can't join them, if you can't beat them, join them. And that may not be the right attitude, but what I have found thus far is that I run on a basically 3-to-1 risk reward, and more days than not, I'm making what I'm setting out to do, particularly when it is trending like a day like today. So when they start to hit it, they just hit it and off it goes, and you're off to the races. So it's been pretty fun. What I'd like to do now is maybe go around, ask everybody if there is a trade of the week that they'd like to share, or just a trade that they'd like to share with people today. And we'll move back and we'll start with the top of the roster, and that would be Christian.
All right, let me go. Let me see if I can go ahead and share my screen. Let's see. There we go.
Yeah, it should come up.
All right, I should be sharing there. Okay, so I've got Lowe's up here. At this point, what I'm looking for, normally when I come on, I usually have a couple ideas. I usually throw 2 ideas out there, but at this stage, just kind of watching what the market is doing right now, and I think a couple levels were thrown out in the S&P. Those levels I'm also watching. I think the 100-day moving average is going to be interesting as well for the S&P. So I think kind of I'm in more of a wait and see just for today, and just want to get through to the FOMC meeting. One of the things that I've noticed in option activity, first of all, it's been very, 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 very light aggressive call buying. So this tells me that people have been sitting on their hands. They were doing this all throughout last week as well. I think we had one day where we really saw some buyers come in and bought some calls in a couple of different names. But for the most part, towards the end of last week, very, very, very quiet. And that's what it is like today on the call side. So one area that I have seen some call buying is in Lowe's. And I like this because, going back to what I said originally, I'm looking for easy trades. So notice you got this white line that's all the way back here. That's the 200-day moving average. I don't think it's ready yet. I would like to see an MACD crossover for some confirmation here. So I'm not in a rush in this particular trade, but clearly somebody's going out and they're giving it plenty of time. So this is the order flow today in Lowe's. They're kind of just in pieces. It appears that they're buying some July 85 calls. So basically right at the money calls, and they're going out to July. I mean, this is a pretty decent sized trade. It's very similar to what they did on Friday as well on the call side in Lowe's. And this is Friday's action. Actually, I could just go to, and you can see that there's a similar amount. It was actually only 5,000, which is about a $3.3 million trade. So someone appears to be drawing a line in the sand for Lowe's, and it's right on the 200-day moving average. So this works to my advantage, where I'm seeing someone basically say, hey, this is a great area. Lowe's was up to 109, had a bad earnings report, but has just been kind of digesting here. So they're going all the way out to July. It's a longer term trade. And then, for me, which is basically how I use option activity, I'm just looking for an idea, and then I use my own model to kind of help me along with that. So I'll have my stop set at the 200-day moving average. If it doesn't work, it's a pretty it's a pretty simple trade. If it falls below the 200-day moving average, I'm out. But for now, let's see if this thing can bounce and maybe get into the earnings gap. And that's it.
Thank you very much, Lance.
Yeah, so normally I have a few odd stocks I like to talk about and go over. The option activity recently has been very light, especially today. What I've noticed just in the short term, we're seeing really over the past couple months or so, we've seen a lot of short-term option activity. Basically, there's been no commitment to the options market going out, let's say September, December, further dated, which, last year and the previous years we've seen. Everyone seems to be, I'll risk some capital for the short term. If it moves, great. If it doesn't, so be it. So it basically tells me a lot of big funds and traders aren't making too much of a commitment to the market, which, I get. We've been pretty choppy, and then you have a day like today to where, you really don't want to be involved, or if you're long, you're taking some pain. One that caught my attention Friday was letter X. We had, the steel news, the tariff news, all that. Recently people thought it would be great for X. X had a big run up to it. And then once we got the news, we kind of, paused. And you could say recently over the past few days, it's been a mess. We did have the breakout on February 16th where we broke from about 38 and we traded all the way up to, I think, 44. So Friday, we saw a trader come in and buy a block of 10,000 April 42 calls for 98 cents. It was again, April short dated options, but it was something that, when letter X call buyers have stepped in, I know from previous experience, they're usually pretty spot on. So we did see letter X with a nice rally. I think it rallied something like 5% on Friday. So I was coming in today looking at it because this morning it held up pretty well. Now we're down about 3% to see if there's going to be any follow through. Obviously, with the market being weak, now letter X is suffering. But that's one name I'm looking at. I like when we pull back to support or demand right here from the prior rally here, right around 38. If we could stall and start trending up, I really want to see us close above 40, and we kind of take this short-term bottom, hold it, and start trending up. I'm going to look for a swing trade in letter X. Friday I came in, I bought some weekly that expired on Friday options for 12 cents. Sold them at 56 cents, which was great. They actually traded up to like 93 cents. I wish I could say I got out the highs, but just something that catches my attention. When everyone's been burned with the tariff news and traders and investors, they all thought it was going to be good for steel. Then they all got stopped out off our last downturn. I usually like to look for opportunities to where when nobody loves a stock or nobody loves a market, I'll come in and start peppering in or start looking to get involved in something, kind of take, the counter to what everyone else is thinking. And letter X is one of those names right now that has got my attention. Great.
Thank you very much. And Jim.
Okay, on a little bit more of a macro feeling, we seemed like we're going to be having a little bit of a fight here between higher rates and the valuations of stocks. And so, as far as looking at the market in a little bit more of a wider range situation, since the 2800 area was kind of the top of the range, 2850 last week when we got up there, that was the opportunity to put on some sell strategies if you're a believer that we weren't going to go up and take out the highs. So obviously that opportunity has come and gone a bit. As you can see, there's a real pretty good meltdown here today, right?
Right.
So, what to do next? What would be the next thing I would be thinking about? Well, I would be thinking about what's ahead as far as things that would make it turn back up. And that would be your Q1 earnings. And when they do their earnings, if they beat and they increase their dividends, that would be positive. If this inflation news on wages and prices continues to be pretty moderate and you start hearing any merger and acquisition news or repad buying, it's supposed to be going up towards 800 billion this year. That's a lot of buying if it does show up. So, fighting the tape on that doesn't sound like a genius idea. But you do need to have some things, in my view, to make myself comfortable. So that would be either a break above last week's prices, 2770, 2800, and correspondingly, I've been watching the VIX. They brought it to 1330 one day, but they couldn't keep it there. They brought it to 14 and change, but they couldn't keep it there. So I'd like to see the VIX maintain a sub 15 price level, and I'd like to see some resistance taken out before I would feel comfortable that the train's going back up. Right now, I think it's a defensive market right now, a trading range market. And I think the strategies such as collars into the big advance was very, very sharp. And I think right now, 2650, 2680, let's see if that holds. 25.30, 25.50. Let's see if that holds. And then if there were to be a turnaround this week, Tuesdays and Thursdays seem to be fairly good days for turnarounds if they're going to happen. So, all this selling here today, if they call the dogs off, turnaround Tuesday could happen. And if not, you would like to see a turnaround by Thursday. And if it can't do those two things, then the decline would probably be more severe than we're looking at. But, a lot of the charts look like they're trying to roll over a little bit, and we're not rolling over from the valley here. We're rolling over, from a high point. And, the public, obviously, like I think Lance was saying, they're not used to their statements going down.
Right.
They've gotten into a situation where they think stocks is an asset that grows and then you make money on it all the time. And certainly it has been that way, but it's not always that way. And I don't think anybody would even think that we peaked out at 2,900 and that was the blow off top. And wouldn't that surprise people if that actually was the case, that 2,900 was the blow off, 2,700 on the Dow was the blow off? And we may have a very difficult time seeing those levels. If you went to a cocktail party and started talking like that, they'd probably kick you out. So the bottom line is right now we're on the defensive. We're going to try to hold some levels, I think, that I just mentioned. There is a lot of things that could turn this thing around, and the tape on an overall basis is still positive. So, we're still talking about support. Okay. And again, who's going to be doing all the buying? There's got to be the question. Where's the money going to come from to buy? Well, it's got to come from that repat money. And then, of course, the way the banks have been deregulated, Lord knows they could be loaning people money to do whatever they want to do with it, because the regs have been released. And leveraged lending, which is where the M&A activity comes from at a Goldman, those rules have been released. So there is a lot of tigers in the cages here that could come in and buy. So by no means am I saying, this thing is totally over. But, if these rates were to go a lot higher than people think and valuations became very concerning, I know the earnings are going to be great. They're going to be great, but, they may not be great forever. And people do look 6 and 12 months down the road. And a lot of these people on GDP, they're not looking for GDP to be soaring in 2020. They're looking for GDP to actually be contracting in 2020. And for God's sake, before we know it, it'll be 2019 the way time flies. So, like I say, I think right now parameters are important to look at. And then, if you're against resistance at 2,800, well, if we're going to come down like we are now, most all stocks are going to come down. Unless you can find the one-eyed man in the valley of the blind, and that's not an easy racket. So having some kind of themes on where there's support and where's there resistance can also be used for your trading as well. And I think that's about it.
Thank you. That was very detailed and a very appropriate response. I kind of wanted, just before I really go into, because I trade futures and I basically have shifted over to being a day trader, I have 2 core positions, and that is being long gold and short bonds. I continue to hold that. I do believe that inflation is going to come in and play a much larger part in the marketplace. And I don't think people are really expecting that. I was speaking a little bit before we started today's show on how much people really understand that what we have going on is like every time they see the market go down, it's like, oh, you buy the dips because it has to go back up. And that to me is the status quo. Right. And I agree with something you said, Jim, in the fact that there are, with the deregulation, or just the lifting of these regulations on our financial institutions, I think has produced a picture where I'm seeing large firms, I don't know who, but they'll come in and they're just reversing maybe a position in terms of they're buying the stocks and selling the futures, or buying the futures and selling the stocks. But in any case, I feel that there's some, what I'm calling manipulation in the market. At least we saw last week that at a certain time of the day, they just walked in and they bought it and they bought it and they bought it. When I'm watching the Dow go up 200 points and I'm watching the NASDAQ go up 50 or 60 points, that takes a lot of money to push it up there. So my question's always been, whose money is that? Who's actually coming in and buying our markets relatively at their highs, particularly in the NASDAQ, as we saw when they zipped it above 7,000 and just kept on going. And that's a tremendous amount of money in a thin market that someone's out there spending. And that is, whose money is it? Is it retail? Is it borrowed? You know, everything that you mentioned, Jim. So I think that your points are very well taken, at least by me, and I'm hoping by everybody else as well.
Yeah, one last thing I just want to interject is that, you know, a lot of the easy lifting has been done with regards to, I mean, it's not hard to convince people that you're going to lower their taxes from 35 to 20, and that the banks are going to be deregulated. These are not tough things. That's like handing out ice cream and pizzas to people, you know. Right. But on the other side now, you've got the Fed balance sheet having to be shrunk, and you've got a guy who's trying to normalize rates, which in my mind could mean 4% or 5% even on the 30-year. Right. And so, you know, those things are like asking people to go to the gym. They're not quite as much fun as getting ice cream and cake. So, you know, right. This guy, Trump, you know, I'm not being political here, but a lot of his easy lifting is behind him. And now the more difficult stuff like budget deficits that explode because revenue doesn't come in, right. And things such as Fed balance sheet having to be shrunk and normalizing interest rates. You know, I don't know that that's the kind of music that a 2,900 S&P wants to listen to.
Totally agree with you on that. I totally agree. From my side, in terms of positions, I think it's wise to be very prepared for what I believe is coming, and I do not see the market running for the balance of this year. I know that there's a lot that they'll disagree with me, but I think that we have reached our pinnacle. But again, I always have to leave a little bit of room in case they decide they are going to run it up another couple thousand points, Dow points. But I don't see the interest rates being able to be held artificially low for any longer. I think inflation is going to come in and it's going to just do its dirty work. And I don't think people are prepared for it. I don't think people, either they don't want to hear it or they just don't think that it can happen. And I think that's where the danger lies. We saw, for example, with the VIX and that sudden plunge that we did, and they blamed it on, you know, traders of VIX options being short and then having to cover, et cetera, et cetera. That may have been the case, and I'm sure that it was a part of it. But I also believe that there's been this status quo feeling amongst large traders and even amongst some of the not so large traders that you sell volatility, you sell premium. Now, you guys are all option traders, and so you know it's like a lot of times that's exactly what you do. And so I think that people, you know, these large firms were buying stock or buying, you know, large positions in options and selling the VIX to hedge in a volatility basis. And I think that was pretty crazy, and they got caught at it.
One last thing about that VIX. If we are in a trading range, the VIX trading range has been about 15 plus or minus, 25 plus or minus. So when the VIX jumps up here towards 25, you know, obviously that would give some credence that it could bounce out of here. And then the VIX would obviously be reduced at that point. So that's another trading range to keep an eye on, is the VIX 25-15 trading range.
Okay.
I'll jump in here real quick. Yeah, I mean, I think with the whole volatility trade, you know, I think you have a lot of traders doing have a lot of muscle memory in some of these things where, you know, if the trade continues to work, people are going to continue to do it, right?
Right.
Until it doesn't work anymore, right? And that's a habit with not only just the volatility trade, but just a lot of trades. You know, people will continue to do those trades until it doesn't work anymore. So I don't fault people for doing that trade. It worked great for for a few years, I think the game has changed. When you see the VIX, getting from a level, more into, increasing rather than continuing to go down, I think that changes the game a little bit. And I do think that that's overall healthy for the market. I think what was really unhealthy for a while is when we're sitting at a VIX of, below 15, hanging around 11, 12.
Right.
That's just unhealthy for the market. So this actually makes me feel, a little bit better about the overall market. The fact that there's a little bit more fear, in the market. You look at the fear and greed index, which one of the components of the fear and greed index is the VIX itself. But you look at that, I have a very tough time with the VIX staying, around, under 50. Right now I think it's around the fear and greed index. 20, 30, I have a tough time. I'll just take the counterpoint of that just for a second, because I think this is good to debate. But I think with the amount of fear that's gotten into the market right now, I think that's a good thing. And you go back to the company fundamentals and recent earnings reports, until that starts to decline, I don't really see, or until we really start to break, call it the S&P or the Q's just made a 52-week high. So I don't think that we could really, my opinion is calling a top at this point. I would definitely not do. I think I think the leaders are going to continue to lead, and until really earnings starts to flip out, going back a couple of years ago, what we saw for a long time was a little bit more of the financial engineering, where earnings were beating on the bottom line and not beating on the top line. Right. Now I think what you've got is companies are really starting to pick up. I think businesses are there's really good business confidence. So besides some of these other mechanics like the VIX trade and so forth, I find it very difficult to be bearish in this environment. There's going to be little snafus with, internationally and so forth, with Trump tweeting, and those are going to bring some short-term volatility into the market. But until you really have companies where the revenue starts to decline, maybe we might see that in the next quarter. Who knows? But you look at every month when the business confidence comes out, it's increasing, and some of those smaller cap companies we saw names like NTNX, Splunk, these are all small business names. These guys are continuing to grow, and they're actually showing profits again, these are the smaller companies who haven't been able to do that. But you look at Adobe last week. If Adobe is not a good proxy for business investment and what's going on in the business world, then I don't know what is. And they had a tremendous quarter, and I think that's bullish. I think you just have to get through. For the time being, you honor your stops. If SPY or if Qs or IWM breaks the 200-day moving average, hey, I'll revisit. But for now, I think you just want to watch little events like a Fed meeting where it's a bit of unknown. We've got, and I think you continue on until it stops working.
Yeah, if you're a believer, this is a dip to be bought. There's no doubt about it, because the primary trend is still up. So there's no question about that. The thing is we never know when the high is hit. And so obviously it's rank speculation to say that it has hit a high, because there's not enough price evidence or fundamental evidence to even say that. But the point is that, in hindsight, if it was the high, we would all say that nobody really was talking about it at the time.
Right.
That's very true. That is very true, that nobody was talking about it at the time. But I do think that there were some out there positioning themselves more on a technical basis than they are on a fundamental basis. And I think that's been a big change within the marketplace, that things have gotten more technical. So you're buying and you're selling on technical signals versus fundamental signals. And I don't know if that's good or bad. I heard you, Jim, and I heard Christian, basically talking about fundamental analysis in the marketplace. And I know that a lot of retail trading still revolves around that. But as someone who's, we're up here trading every day, my question would be, at what point do we realize that past performance is not a guarantee of future? So in other words, we're getting earnings from a quarter that's already taken place. Mm-hmm. Is that spelling that that's going to happen again in the next quarter and the following quarter and the quarter after that? We don't know. And so I think that there's a lot of questionable things in the market that affect how people make their decisions. And I think that we're running on a period of time where people are still going on the fact that if you're in it for the long haul, and if you're in it for the long haul, you sit through these little dips, and because it always comes out the other end, and they're basing that on going back 50 or 60 years and looking at the S&P. And that's my point about the status quo. I'm a firm believer that the status quo is changing. It's very subtle, but it is changing. And I don't believe that a lot of people that are in the markets, and I'm talking across the board, really understand it and are positioning themselves to get hurt pretty severely. But enough said. I did want to go back to one thing and say, we asked the question about, do you use currently any type of auto trading executions in your strategies? The respondents to the questionnaire, where 15% said yes, they do currently. 9% said yes previously, but they don't anymore. But 75% said no, never. And that I find very, very interesting. That people get very stuck, and again, I think it's partially fear. You're giving over your ability to trade to a computer, and that's programmed to go in and do it for you. And I think there's just a lot of what I've gotten from people is like, well, what happens, if my electricity goes out? You have a deal with your broker that if you lose contact, if your computer loses contact with their computer, they're in there closing all your orders, closing your positions and your orders. I mean, if you're day trading. I mean, there are different things. But enough said on all that.
I think your point is reality in the way we live. Things are done automatically. If you're in an airplane with an Airbus or something like that, Harry and Joe are not exactly steering it. Actually, it's computerized. Right. And so basically, if you're willing to go to 30,000 feet and go 700 miles an hour, maybe you should be willing to consider something else.
That could be very true. But I'll say that I just came across a news feed that Uber is pulling all of their self-driving cars off the road because there was a fatality. There was an accident with a fatality. So that's going to throw a big wrench into allowing a computer to drive or do self-driving. Let's do one more round of basically closing round. And so any closing statements that you'd like to make? And again, who you are, how people can get a hold of you, and anything else that you might want to add. So again, we'll begin with Christian.
All right, there we go. Just unmuted the microphone. Yeah, and again, it's great to talk about different views right now. Clearly we've got a lot of things going on. So I appreciate the conversation back and forth. It's great to hear different opinions, and that's why I love being on the panel. Some really great stuff. So you can find me at TribecaTradeGroup.com. Sorry, I'm not sharing the screen. I'll bring that up in 1 second. But you could take a look at what we have going on. We do an analysis throughout the day. And where's the screen share? There we go. So you can find me there, and TribecaTradeGroup.com. You could actually check out our room for free for a couple weeks. You could see what it's like, which I encourage people to do. I've tried giving trial, like a couple-day trial, from time to time, or half off the first month. But I really want people to kind of just see what it's all about for a couple weeks, and get used to the kind of the traders that are in the room, and what we do all day long. So thanks again for having me on. Really appreciate it, and see you guys next time.
Great, thank you. And Lance.
Yeah, so coming on this show, most of the time I hear what everyone says and I do the complete opposite. No, just kidding. But no, hearing the feedback and the overall view from other traders, I do find it useful in trading. It's funny, we come on the show and here we are talking about dip buying and is this the end, inflation, everything like that, and here we are, the Russell rallying, or the IWM looking at a full point off the lows. So that's what makes the market fun. We went from slamming negative 1,200 on the ticks. Now we're, slamming here positive 600, positive 700 on the ticks. So I always like hearing and interacting with other traders. I always say, some people will email me, "Hey, Lance, I have a dumb question. What do you think about this?" And there is no dumb questions in this market at all. If you're an expert, you're a beginner, don't feel like there's really anything, any dumb questions, or even if it's like, "Hey, what's a simple call option?" Stuff like that. Education is very important, and the more knowledge you have in this game, I think the faster the learning process will be. But it sucks losing money. So if you can stay out of a bad trade like today, getting caught and stuff like that, or use the info to make some gains, that's what it's all about. You can find me. I moderate at AlphaShark.com for about an hour a day, and then for myself, personal, I do live stream on Twitch. Here's the not on right now because I'm on the show, but it's under Trading Coach Lance. And then I also have, as you can see on the Twitter, Lance Ippolito. That's Ippolito. And then you can also find me on my website, TradingCoachLance.com. Personal contacts, Slack channel, trade alerts, member videos, all that good stuff I do. And really, I just like interacting with other traders and getting involvement. Especially traders who are new or crossover. I have a lot of poker pros or poker clients that come over into the trading world. And again, having that mindset and a different perspective, I feel like is very valuable in this game. So thanks for having me on. It was great chatting with everyone. And thanks again.
You're welcome. Thank you. And Jim.
Yeah, just Option Professor does have the 7 DVDs and tries to educate you on all the different option strategies that are out there, as many as we can. And again, using the options as a cash flow creator, limited risk speculator, or maybe lately more learning how to hedge. Using calls and puts against certain positions might not be the worst thing in the world. You got weeklies out there to protect yourself for the week or whatever, and then basically trade against the maybe trade against the option or whatever. And then just if you have large positions up there, and some stocks look like they'll never come down, and then all of a sudden you find out they're down 10 or 15%, which if you have a big position is real money. So, the collar strategy is popular with some people because they like somebody else to bring them the cash flow in order to buy the put insurance. And that's and that puts parameters around your equity. So at least when you go to bed at night, you got upside potential to X and you got downside risk to Y, and then you go to bed. So there's lots to learn. And optionprofessor@gmail.com, you can get some more information. And thank you very much for being here, for letting me be here. And thank you everybody else who showed up today as well. Very good.
Thank you. And again, I'm Michael Filighera. If people want to get a hold of me, you can by just addressing an email to michael@logicalsignals.com or michael@mjf1partners.com. And that's the number 1, not spelled out letters. But what I want to kind of put out there for folks today is that I've kind of accepted a challenge from a member of my own trade room, which basically I've closed for now. And she is somebody that I've worked with and have traded with for over 5 years, and now kind of pushed her to go start your own trade room, go and do this. But our challenge is that there are a lot of people in the market right now, or in the trading futures, that have small accounts. And when I say small account, I mean $5,000 to $10,000 versus $25,000 to $50,000 to start trading futures markets. And she is extremely gifted at managing risk and showing others how they can manage their risk and still trade profitably. And I want to just bring that out to people and to take a look and to possibly even take a trial run of the trade room. You can get all that information at www.candlelightTrading.com. And if you go to the website, the normal price for the trade room is $197 a month. But right now, through the end of March, I believe you can get it for a whole lot less, at least $100 less, to kind of come in and give it a test drive and see what's going on. And again, that's candlelightTrading.com. And again, I thank everybody for being here today. And David, I thank you for allowing me to moderate for you today. And I'm going to turn it back over to you.
Yeah, thanks everyone. Great show. And just want to remind everyone watching, be sure to hit the YouTube subscribe button if you haven't yet to get updates on future shows. Also, you can go to TimingResearch.com to get access to any of the reports or the show archives. The Analyze Your Trade show is off this week, so that won't be we won't be having that tomorrow afternoon, but both shows will be back next week. So news on March 26th at 1 p.m. Eastern Time, and the next episode of Analyze Your Trade on March 27th at the new time of 4:30 p.m. Eastern Time. Just want to thank my guests again for this week. Stephen Place of InvestingWithOptions.com was not able to be here today, but we'll try to have him back soon. And Christian Fromhertz of TribecaTradeGroup.com, Lance Ippolito of AlphaShark.com,
Okay.
Jim Kenney, OptionProfessor.com, and Michael Filighera of LogicalSignals.com. Thanks for moderating today. And thanks, everyone.
You're welcome. Thank you.
Thank you.